Well, good morning and happy Monday to you. This is 𝗪𝗵𝘁'𝘀 bringing you the weekly mortgage rate recap and forecast. And the recap is that interest rates started out the week last week higher after the 3-day Labor Day weekend, but they kind of settled down towards the end of the week a little bit. That trend we hope may continue. So why did they settle down? Well, there's some important economic data coming out this week that the market is going to be keeping an eye on and is a little optimistic about. So tomorrow is the inflationary numbers month over month. And we have seen indications that that number is going to be a little bit lower than it was before. We still have year over year pretty high inflation, and that still has to be worked on by the feds to get that under control. But that trend seems to be lowering. That inflationary number seems to be lowering. On Wednesday, then we have the wholesale inflation. Thursday, we have the jobless numbers. And then, let's see, I think Friday is what? Consumer sentiment. Okay, sorry about that. So consumer sentiment, basically just how do people feel about things? How do they feel about the inflationary numbers and how their pocketbook is doing and those kinds of things. And that definitely affects the market. So next week, we hope to see a little bit of a decrease. No, I'm sorry, this week, we hope to see a little bit of a decrease in mortgage interest rates. Leading into the following week, when the Feds meet, the 20th and the 21st, the Federal Reserve Board is going to meet again, as they do, to look at inflationary numbers and determine their policy to fight inflation. Right now, we've got inflationary numbers year over year, somewhere around 8%, and they want that to be 2 to 2.5%. And so they're going to be raising the discount rate, what they charge their best banks overnight. And that also affects the prime rate, which affects home equity lines and credit cards. They're going to be raising that. If the inflationary numbers are positive this week, they may raise the discount rate only 0.5%. If there is anything that's kind of a surprise or they don't think there's the progress they'd like to see, they may raise it 0.75%, as they have the last couple of times that they've met. And so we're hoping that that will again continue to slow inflation so that maybe by the end of this year, into the first quarter of next year, we might see better mortgage rates again. Not what we saw last summer, those ridiculously low, subsidized by the government mortgage rates. We're going to see more of a normal market. But that's going to provide opportunity. The numbers of houses that are on the market have increased, and if these mortgage rates do decrease somewhat, we're going to see some opportunities opening up for buyers. One of those opportunities is the new loan limits. Now, the FHFA is the governing body over Fannie Mae and Freddie Mac, and they publish new loan limits of loan amounts that the government will purchase through Freddie Mac and Fannie Mae. That they do that in November. And so we have already anticipated approximately what that increase is going to be. So we've begun accepting loans, and we're going to fund those loans with higher limits. So right now, or actually before we raise the limit, you could get a conforming conventional up to $647,200, and you just get a better interest rate. And now we're raising that limit up to $715,000 that we will accept and fund those loans. Now that number may be a little bit different in November, but we're going to honor what it is that we are doing now. And then the high balance for high cost areas like Ventura County, Los Angeles County, San Diego County, a lot of those kinds of areas where housing prices are just higher, the limit goes up to $1,073,000 from $970,800 previously. And so the rate is a little bit higher on those high balance loans, but the qualifying guidelines are easier than jumbo markets. Okay, and jumbo market is just loans that are not insured, are not purchased or backed by the government through Fannie Mae or Freddie Mac. And the qualifying on those is just much more difficult. You have to have higher reserves and those kinds of things. So this is a benefit to buyers as well, going into the end of the year where we hope to see some lower interest rates. You can borrow a little bit more, still get the benefit of the guidelines, which are not easy. I mean, it's more difficult to qualify for a loan now than it was before the financial meltdown in 2008, but that's a good thing. And then We also will be able to give you a better interest rate than we could before on anything over 647.2. So if you'd like to know how this affects you personally or somebody that you know and care about, just give me a call, 661-714-2145. Be glad to take a look at your situation and see how these changes and these upcoming expectations will benefit you. So thank you so much for tuning in. I hope you have a wonderful week. Give me a call. I look forward to talking with you.